Understanding listed property, a comprehensive guide. Listed property, as defined by the Internal Revenue Service, IRS, is tangible personal property that can serve both business and personal needs. This classification includes passenger automobiles, transportation-related assets, and property typically associated with entertainment, recreation, or amusement. Recognizing the nuances of listed property can aid business owners in maximizing their tax deductions and optimizing their asset management. Key takeaways. Definition: listed property is a tangible asset eligible for special tax treatment when used predominantly for business. Eligibility: to qualify for advantageous tax deductions, the asset must be used more than 50% for business purposes. Examples: common forms of listed property include passenger vehicles, certain forms of entertainment equipment, and telecommunications devices. Deduction options: businesses can write off the income from named property using Section 179 deductions or various depreciation methods. Understanding listed property. Listed property includes tangible assets owned by businesses that serve a dual purpose. An important stipulation is the more than 50% rule, which can refer to time, mileage, or another relevant metric, and is critical for determining tax liability. These regulations came into existence to curtail the potential for abuse, where personal assets were misrepresented as business tools for tax deductions. Record-keeping requirements. To comply with the IRS, businesses must maintain adequate records related to their listed property. Required documentation includes purchase price of the asset, repair and maintenance costs, evidence documenting the business use. Keeping detailed records is essential, particularly if the IRS were to question the business use of the asset. Examples of listed property. According to IRS Publication 946, several items fall under the category of listed property, including 1. Passenger automobiles, defined as four-wheeled vehicles primarily intended for public road use, typically with a gross weight of 6,000 pounds or less. 2. Transportation vehicles, other vehicles used for transport, excluding those categorized as qualified non-personal use vehicles, such as police cars or ambulances. 3. Entertainment equipment, items broadly used for entertainment purposes, which can range from cameras and video equipment to sound systems and satellite communication devices. Changes in listed property classification. A significant shift occurred with cell phones following a legislative change in 2010, which exempted them from being categorized as listed property, thus lessening the stringent record-keeping requirements. Tax deductions and benefits for listed property. Section 179 Deduction. Listed properties meeting the business use threshold can benefit from the Section 179 deduction. Unlike more traditional deductions that require depreciation over time, Section 179 enables businesses to write off the total cost of qualifying assets in the year they are put into service. For 2023, the maximum deduction is $1.16 million, increasing to $1.22 million for 2024. Specific types of property, such as sport utility vehicles, may have their own limitations, capped at $28,900 in 2023. A critical point to remember: businesses can only deduct costs equivalent to their taxable income for that year, meaning any unused deduction can be carried forward for future use. Depreciation. If an asset's usage falls below the 50% threshold for business purposes, businesses can still depreciate the asset, albeit at a slower rate via the Alternative Depreciation System, ADS. Alternatively, being over the 50% usage for business allows for quicker write-offs using the General Depreciation System, GDS, which typically affords larger upfront deductions. Special Depreciation Allowance. Businesses utilizing listed property more than 50% for business may also benefit from a special depreciation allowance or bonus depreciation. This provision, established in the Tax Cuts and Jobs Act of 2017, enables businesses to write off a significant percentage during the first year of the property's service life. Managing business use of listed property. The critical factor in claiming beneficial tax deductions on listed property is understanding and accurately calculating business use. For vehicles, businesses can utilize mileage logs, while other equipment can be calculated based on hours used for business versus total hours available. Commuting and employee use. It's crucial to note that commuting isn't generally deemed as business use, regardless of whether work is conducted during transit. Employees can claim depreciation on listed property, but only if their usage aligns with employer requirements and conveniences. Mixed-use property versus listed property. While mixed-use property can colloquially refer to listed property, the term gained prominence in real estate to describe buildings that combine commercial and residential tenants. Understanding this distinction is essential for businesses navigating tax implications. Summary. Navigating the landscape of listed property requires vigilance regarding IRS definitions, usage percentages, and record keeping. Businesses that understand these guidelines can harness tax deductions efficiently, enabling them to maximize financial performance while maintaining compliance with tax regulations. Ultimately, proper management of listed property can lead to significant benefits as part of a broader financial strategy.